Okay, traders, in this video, we are going to be talking about how to choose the strike price for you when you sell put options. I get lots of emails from a lot of, new traders, some veteran traders who've never sold put options before. They want to know what's the best strike to choose. How do they figure out? Do I choose out of the money, at the money, even in the money options? Or strike prices, I should say. So in this video, we're going to talk about what's the best strike price for you. We're going to go through each example and out of the money, at the money, in the money. We're going to look at two different stocks, and I'm going to show you how to determine how much money you can get, what the probability is of the option expiring worthless or in the money. Lots of different things to consider. So if you're on the fence, you just don't know which strike price to choose, then you're going to want to watch this video. All right, let's get cracking here. Okay, everyone, Lee Lowell here from smartoptionseller.com. We're going to get back to that screen in a second. Make these free videos for the trading community. I'm trying to help everybody. I've got over 30 plus years in the trading business myself, trading commodities, options, futures, stocks, all that good stuff. And trading options has basically been my life for over the last 30 years, and I love it, and I'm going to continue to do it. I'm going to continue to make these videos, all right? So let's talk about selling put options and how to choose the right strike price. Let's just take a quick step back for a second and just make sure we're all on the same page about what selling put options is all about, okay? Now, when you sell a put option, now you're not the buyer, you are the seller of the put option as your initial transaction, and you do not need to own that put option prior to selling it. What you're going to do is basically out of thin air, you're going to sell this put option contract and you're going to get money for it. Okay, that's what happens when you sell a put option. In addition to that, you're going to get the money right up front. When you sell that put option contract, you get the money right up front from the put option buyer. But at the same time, now it obligates you to potentially buy shares of that specific stock at that specific strike price. And the strike price is the level at where you would have to end up buying shares of that stock if it came to fruition. Okay, so I want to make sure everyone understands this. It's like an insurance contract. You're selling an insurance product to somebody who's trying to cover shares of stock that they already own that may want to sell those shares sometime in the future. So what you're doing is you're providing insurance to them on their stock. And what that means is that you will step in sometime in the future and buy the shares from them if they need to sell them. Okay, but you're in control all the time. As the put option seller, you get to choose the stock, you get to choose the strike price that you sell, you get to choose the expiration date. So you really are in control when you're selling a put option contract. So let's talk about how to choose which strike price to sell. And I've got a little Google Doc here that I want to bring up on the screen. Okay, now which strikes to sell put options? So we understand everyone wants that let's understand that you want to sell a put option contract. You basically pick the stock, and now you want to collect some income, which is great because selling put options creates this new instant income stream for yourself, but you have to choose one. All right. So I'm going to show you the three types of examples of strike prices that you can choose. And it's either out of the money, at the money, or in the money. Now, what does that mean? For some of you that are unfamiliar with those terms, let's just say the stock's at $100 per share. And we're talking about put options here. An out of the money strike put option has its strike listed below the current stock price. So if the stock's at 100, anything below 100 is considered out of the money. Now we're talking the 95 strike puts, the 90 strike, 85, 80, all the way down. Anything lower than the stock price is considered out of the money. Now, if the strike price is the same as the current stock price, let's say the 100 strike puts, that's what's considered at the money. And you can even consider if it's got strikes listed at every dollar, like 99, 98, 102, 101, those could be considered at the money. The strike prices that are right around the current price of the stock, okay? And in the money put options has their strike prices listed above the current price of the stock. So we're talking 105, 110, 120, 150. Those are what's called in the money strike put options. Now, each one of those will go for a different price, a different value. You'll get paid different amounts of money depending on whether you sell an out of the money, and depends on whether it's really far out of the money. And the at the monies will pay more, and the in the money puts pay a lot of money. Okay? And they're all based on how bullish you are or how aggressive you want to be when you sell these things. So a lot of it comes down to your opinion on the stock, how aggressive you want to be, what are the chances are of you being assigned. That means what are the chances of you actually having to get to buy the shares of the stock. Now, what I want to make sure that everyone understands is that if the stock's at 100 and you sold an out of the money $90 strike put option, that means the stock has to fall below $90 per share at the expiration date in order for you to be assigned the shares. And that means that the put option buyer is going to exercise his contract and he's going to make you buy those shares at $90 a share. So when you started the transaction, the stock was at 90, and at expiration, the stock has fallen below 90. So that means you're now on the hook to actually buy the shares at $90 a share and pay out your $9,000. Okay, you're buying 100 shares. Every option contract consists of 100 shares of stock. So when you buy those shares, it's going to cost you the 100 times whatever the strike price is. In this case, it's $90 times 100, that's $9,000. So you need to make sure that you're okay with potentially buying shares at that strike price. So let's look at a couple examples here. We're going to look at Coca-Cola and we're going to look at Tesla, two very, very different types of stocks that pay very different amounts for all the strikes concerned. And I want you to understand what the probabilities are of you potentially having to buy those shares of stock. So number one, let's look at the stock charts. Let's pull this up. So let's just say that you've decided that you want to sell put options. You want to create this income for yourself. And you're not really sure if you want to really buy the shares yet. Okay, let's take Coca-Cola, for example. Here's a daily chart of Coca-Cola over the last 2 years or so. And it's gone from a low of $52 up to about $74 over the last couple years. You know, a 22-point range in the stock for that stock. Not a huge move, between the highs and the low over a 2-year period, but it's right around $70 per share. And you're thinking, all right, you know what? It's a stable stock. I know it really doesn't move that far. I would be okay potentially buying shares of Coca-Cola, but you have to decide where would you potentially be okay buying those shares? Do you want to do an at the money, which means you would sell an at the money $70 strike? Or do you want a little cushion for error and go down to maybe the 65 strike, which is, down here? And you can even go further. Instead of the 65s, you can look down at the 60s and see how much those are paying. So what that basically says is that if you sold a 60 strike put option on Coca-Cola, you're on the hook to potentially buy the shares, 100 shares of Coca-Cola at $60 a share. Right now it's at 70, so you're giving yourself a $10 cushion. Now, if you're really bullish on Coca-Cola, you can sell the 75 in the money puts. Coca-Cola is at 70, so you're contracting yourself out to potentially buy Coca-Cola for $75 a share. So some people would say, why would I want to buy Coca-Cola at $75 when I can buy it at 70 right now in the current market? Well, because you're going to get compensated. When you sell that put option, you're going to get compensated more than $5 per share, more than $500 in actual dollars for selling that put option, because since you're contracting yourself out to buy Coca-Cola at 75 while it's currently trading at 70, you got to receive at least $5 per share or per contract in order to make it worthwhile for you. So we're going to look at the option chains. I'm going to show you how that is. All right. So we're looking at Coca-Cola here. It's trading around $70 a share. Let's pull up the option chain. Okay. Here's the option chain of Coca-Cola. Put options on the right-hand side. So we're going to go over that. We're looking at the October 17, 2025 expiration. And you can see stocks have all different expirations. A lot of them have weekly, every Friday expirations, and what these are called the regular. Those are the third Friday of every month. Those are the traditional monthly expirations. Most stocks have weekly expirations as well. Okay, so we're looking at Coca-Cola, October 17, 2025, and the 70 puts right here. This is how it went out on Friday, August 22nd, 2025. 166 bid at 172. Something right in the middle is about $1.69 per contract, which is 169 actual dollars. You multiply these numbers by 100 because there's 100 shares of stock in every option contract. So if you sold one of these $70 put Coca-Cola options for $1.69 per contract, you would immediately get $169 in your pocket. Now what happens is now you're on the hook to potentially buy 100 shares of Coca-Cola at $70 a share, but you got that $1.69 up front, which actually makes your cost basis of $68.31 per share if you get assigned, because you can subtract the amount you received from the strike price. That gives you your actual cost basis. Now, all you have to do at this point is wait to see where Coca-Cola ends up in October. If Coca-Cola finishes below 70, you're going to have to buy your 100 shares at $70 a share and pay out $7,000, but you already got that $169 up front. So as I said, your cost basis would be the $68.31 per contract. So you have to ask yourself, would I be comfortable potentially buying shares of Coca-Cola at $70 based on the amount of money I got? Now, if you want to go a little bit, give yourself more cushion, as I said, you can go down to the 65 strike here. You're going to give yourself $5 of cushion from where Coca-Cola is currently trading right now, which is the $70 right here. And you can sell these things for about 39 or 40 cents per contract, which is 39 or 40 actual dollars. And you subtract that from 65, so you're looking at basically a $64.60 cost basis if you had to buy those shares. Now, Coca-Cola would have to fall below $65 in order for you to get assigned at expiration. So you've got a $5 cushion there, and so you just sit there and wait. Now, you can go down to the 60 strike if you want. This one's a little bit wide, the bid-ask spread. So this thing's probably worth about, I'd say, maybe 15 cents per contract, somewhere in that range. So you'll get 15 actual dollars. And now your cost basis would be just under $60 a share, $59.85 if you want to be exact. So the lower you go in strikes, the less money you receive, but the more cushion that you get, and the lower probability it is of you getting assigned. So if you just want to collect the money, if you just want to sell put options to collect the cash and not really have to buy the shares, it's really smart to go, down in the out of the money strikes where the probabilities of having to buy the shares is much smaller. You'll get less money when you sell it, but the probabilities are much smaller of you having to buy those shares. Now, you can look at the delta as a quick and dirty way to figure out what are the chances of that happening to you, meaning what are the chances of you having to buy the shares of the stock. So the 60 strike put has a delta of just around 5%. Okay, it's a percentage number, meaning there's only a 5% chance that Coca-Cola stock's going to finish below $60 a share by October 17, 2025. Conversely, if you sold the 65 puts, the deltas are roughly 15%. So now you have a 15% chance of potentially Coca-Cola falling down to 65 by expiration. And if you do the 70 puts, which are at the money, they typically have somewhere in the 50% range. So if you scroll over, so it's just under 50% here, meaning it's a coin toss. Based on when you sell that contract, stocks, right near $70, typically you're going to have a 50-50 chance of you having to buy the shares at expiration. Now, selling put options is more of a bullish strategy, and they work very well because most of the time, if you concentrate on quality stocks, most of the time the stocks are going to go up over time. And as the stock moves up and as time erodes towards expiration, these option values start to get lower in value. So right now you can sell it for $1.69. If Coca-Cola stock starts to go up, this value, all put option values, start to decline. So as an option seller, that is what you're looking to happen. You want your option value to decline in value. Whereas the other way around, when you buy a stock or you buy an option, you want that option value to go up so you can sell it for a higher price and lock in a gain. Well, when you sell options, it's kind of like reverse. You sell the option at one price, but you want that option value to go down. So if you close the trade early, you can buy that option back for a cheaper price and lock in your gain that way. So let's just say Coca-Cola went up over the next month, and all of a sudden these things are worth $1.25 per contract. Okay, so you sold it for $1.69. Now it's worth $1.25. You can buy it back for $1.25. That'll close out the trade, and you've locked in that gain from $1.69 where you sold it to $1.25 where you bought it back, and you've made that 44 cent per contract gain, or 44 actual dollars. Same thing with the 60 puts. If you sold this thing for 15 cents and all of a sudden, next month it's worth 2 cents per contract, you could buy it back for 2 cents a contract and lock in your 13 cent or 13 actual dollar gain. Now let's talk about selling these 75 puts that are in the money. Okay, I talked to you about the in the money puts. You can see it's worth about $5 and let's say $5.33 a contract, somewhere around there. So if you subtract the $5.30, let's just say you can sell for $5.30 a contract. Subtract that from 75. Now your cost basis would be $69.65. No, 70 cents. $69.70 per share, which is lower than where it's currently trading now. So I said to you, why would someone want to buy it at $75 potentially when it's currently trading at 70? And the answer is because you're getting compensated for that. Okay, you're getting compensated $5.30 a contract. It would make your cost basis $69.70 per share if you had to buy the shares at expiration. So if Coca-Cola ended below $75 at expiration, you still would have to fulfill your obligation and buy the shares at $75, knowing that you got compensated. Let's just say Coca-Cola finished at $73 per share at expiration. You'd get to buy the shares, and you have your $69.70 per share cost basis. You could turn around and just sell them out at $73 and lock in your gain that way. Or you can hold on to the shares and let Coca-Cola ride up for however long you want. Okay, so selling these in the money puts is an extremely bullish idea. Okay, you really think that Coca-Cola is going to go up above $75 by the expiration date, and if it doesn't, you get assigned the shares, and you have to hold on to them if you want, and see if Coca-Cola goes up, or you can sell them for a loss or a gain, whatever's going on at that time. We don't know where the stock's going to be at that time. If you sold the 70 puts, as I said, it's a coin toss. You don't know what's going to happen. But selling puts is a bullish strategy. So you really want to be bullish on the stock. Let's take a look at the stock chart of Coca-Cola. Okay, in the long run, let's go out to a monthly chart here. This is the daily chart. Here's the monthly chart. I mean, Coca-Cola over the long run goes up over time. So if you're bullish on Coca-Cola for the long run and you think the stock's going to keep going up, those put option values are going to decline and you could eventually buy them back cheaper. Now, if Coca-Cola finishes above $75 at expiration, those 75 puts are going to have zero value at expiration. So you'll just collect your $530, but you don't get to buy the shares. That's the thing. If Coca-Cola finishes above your strike price, you won't get assigned and you won't get to buy the shares. You'll just walk away with the premium income that you collected on day one. So if Coca-Cola finishes at $76 per share, you'll just keep your $530, but you don't get to buy the shares. So you can sell another in the money put if you want. Same thing with the at the money and out of the money puts. You can resell these things, once they expire. So you can have this ongoing income, every couple months or however long your, expiration period is. Now let's take a quick look at some people say, well, I want to sell these things, every week. I want to collect money every week because I need to make money. Well, if you go to August 29th, which is the closest expiration date, 6 days from now, and these are the numbers that reflect yesterday's trading, August 22nd, 2025. So the 70 puts you can see right here, these at the monies, we're trading about 49 cents a contract. So you only get $49. Whereas in the October, you're getting $169. So the shorter the expiration, the less money you're going to get. So you have to factor that in. Now, the 75 puts, you're still going to get close to, it's going to be it looks like it's under $5. So you got to be careful. If you sold these things for, let's say, $4.70, now your cost basis is $70.25. So you're actually going to be buying them higher than where the current market is. So you got to watch out for that. And the 65 puts, you can only sell for 2 cents a contract. So the shorter the expiration, the less money you get. Now, if we go out, let's say we go out like a little over a year in time to September 2026, you can see now those 65 puts are trading, over $2.70 a contract. The 60s are about $1.50 something contract. And you can even go down to the 50 puts. These things are probably worth about 50 cents a contract, $50. So if you go back to the stock chart here, Here's $50. Well, can't even see it on the chart yet. There's $50 all the way down here. So these are the things we like to do. Coca-Cola's at 70 all the way down to 50. If you sell that 1 year out contract, you're going to get $50 a contract. But now you're potentially, you can buy Coca-Cola for $50 a share. It's a $20 discount. It's over 20% buffer. All right. So these are some things you need to consider. How far out in time do you want to go? How much money do you want to get? How aggressive are you? How bullish are you on the stock? That'll all determine, which strike price you want to sell. Now let's look at a stock like Tesla. We're going to compare Coca-Cola to Tesla and see. Now, Tesla's a very erratic stock, very volatile. Here's the monthly chart. Goes up, down, up, big down, up, down, up, down. So compared to Coca-Cola, which is a nice, slow, uptrending, long stock. Here's the monthly chart, just waiting for these numbers to fill in here. Nice, slow, long, uptrending. And then back to Tesla, which is just extremely erratic. So let's look at the option chain for Tesla and see how that compares. Okay, here's your put options for Tesla. Same expiration. The at the money here, so trading around $341 a share. So we'll look at the 340s, which is the closest at the money strike. You can get over $2,400 in your pocket if you sell one of these 340 strike puts. $2,400 compared to $169 for Coca-Cola. Now, of course, you're on the hook here. You're putting yourself on the hook to potentially buy 100 shares for $340. Tesla could crap out. It could go below $300 and you're holding on to, a losing trade. So that's why if you're looking at these really erratic stocks, volatile stocks that do pay out a lot of money, you probably want to go more out of the money when you sell these things to give yourself some kind of buffer. Now look at this. You can go all the way down to let's look at the right here. I'm looking at these 205 strike puts. 205, which is over 100 and what's that? $130 something below where Tesla currently trades. You can get $100 in your pocket. $1 per contract is $100 actual dollars. So you sell this one put option contract. Now, remember, these are not real recommendations. These are just examples of what you can get. You sell a 205 put for $100, and you go back to the chart, and let's see where $100 is. $200. Okay, so $200 is right here, 205 to be exact as the strike price. So it hasn't hit 205 basically since August of 2024. So last summer, can Tesla fall down to 205 in the next few months to October? It's a possibility. That's when we're going to check the probability calculator in a second. But, if you sold even if you went way out of the money, let's say these 165 puts, you can at least get $50 a contract for the 165s. That's almost $180 below where it's currently trading now. All right. $185 is somewhere like around here. Or what strike were we looking at? I'm sorry, the 165s. The 165s are all the way like down here. So you have all this buffer. But it all depends on your feelings on Tesla. How bullish are you? How aggressive do you want to be? Now, if you sold an in the money put, if you're really bullish on Tesla and you think it's going to go above $400 in the next few months in October, you can sell a 400 strike put, which would pay you out based on the last price. This thing's paying almost $6,700. $6,700 in your pocket. Subtract that from 400 and you're looking at, roughly 330 something cost basis, which is currently below where Tesla's trading now. So you have to figure, is Tesla going to rally up to $400? Because if it does, these things would expire worthless and you'll walk away with the $6,700 in your pocket, but you won't get to buy any shares. So you got to figure, what kind of trade do you want? Now, if you go out to September of next year, just as we did with Coca-Cola, and you look at the current at the monies, which is the 340s, now you're looking at, again, $6,700 just for the at the monies. Now you can go all the way. Let's see how far we can go out of the money 1 year out in time. Wow, look at these numbers. if you sell Tesla, if you sell the 50 strike put on Tesla, 50 strike put, you can get almost $70 in your pocket, almost 70 cents per contract. $50. Can Tesla fall all the way down to $50 from $341 in the next a little over 1 year? Okay, let's look at the chart. Let's look to see where $50 is all the way down here. Okay, in 1 year's time, it hasn't hit $50. And when was the last time Tesla hit $50? That was in 2020, like right around COVID. And so there you go. Now, lastly, I want to show you the probability calculator so you can understand these things. As I told you, you can look at the delta as a quick way to figure out what are the chances of you getting assigned or the stock being in the money at that point. Now, once again, the 340s should be right around that 50% delta. In this case, it's 37 and change, okay? So, because it is above 340. And even the 350s, which are in the money, has a little higher delta, okay? So that's just, it's looking at more of an upward bias. If we go to the Octobers, the 340s probably have closer to a 50% delta, okay, 45%, all right? So the longer you go out in time, some of those at the money put options won't have an extremely right at the 50% delta, but it's going to be somewhere close to it. Let's look at the probability calculator here for a second. And, let me just show you how that works. This is a probability calculator we have on our website that helps us understand, what are the chances of the stock moving from point A to point B. Now, as I said, you can use the delta, but the probability calculator lets you do what if scenarios. Okay, so let's put in this stock price of $341, and we're going to go out to the expiration date of October 17th. And the volatility for Tesla for October, we can look at the monies, which is about 47.8%. And if that would be the volatility right at you can look at the model IV column as well, 47.8 here, 47.8 here. And so we'll put in 48% in the calculator, right? That's what we want to use. We'll use 48%. It's a percentage number. Just type it in as 48. And we in the target boxes, we want to see what are the chances of Tesla falling below a certain level. So in this case, let's just say 260 was our level that we were going to sell some put options for October, and click on go. So here's what it's telling us. There's only a 7.27% chance that Tesla's going to finish below 260 by the October expiration. Conversely, there's a 92.7% chance it will remain above 260. So you have to decide, what's my goal here? Am I here just to collect the cash, or would I be okay potentially buying shares of Tesla? If you're okay buying shares of Tesla at $260, you still have a 92.7% chance that's not going to happen. You'll just collect your money and move on to the next trade, and you'll sell another put option, for a further out month. In the meantime, you'll get the cash. Let's see what those 260s were paying for October in Tesla. The October 260s were paying about $300, $3 per contract. Let's see where it went out. Yep, about $300 you'll get in your pocket for putting yourself on the line to potentially buy shares of Tesla at $260. So you have to figure, what stock do you want to choose, and make sure it's a stock that you potentially want to buy. How aggressive are you? How bullish are you? How much cushion do you want to get? And then just go through the option chain, the expiration dates, and see how much money you'll get. Okay, that's really all it is. It's a simple strategy. Just know that you may be on the hook to buy these shares. So you do have to make sure that you have the money come expiration to potentially buy those shares of stock. Now, while the trade is active, if you're using a margin account, you don't have to have the full amount of the dollars to actually buy those shares. Your broker will make you hold aside, a percentage of that amount. And what is that percentage? Well, you have to go into your broker's platform. When you load up the option trade, it'll show you how much money you have to keep aside in order to sell that put option. And lastly, you have to make sure that you're approved to sell what these are called naked put options, selling naked put options. So you have to make sure you're approved to do that. All right, that's it. Let's go back to the Google Doc again real quick here. So choose your poison. Which strike do you want to choose? The out of the monies give you a lot of cushion for directional error, gives you less of a chance of getting assigned, but you're going to get less cash up front. at the monies is the middle of the road. You know, there's like a 50-50 chance that the stock will finish above or below that strike price, but you'll get more money when you sell them. And then in the monies, you're going to get a lot of money up front, but there's a really high chance that you'll get assigned at expiration unless the stock really goes higher like you thought it would. So you got to figure out what you want to do. All right, that's it for this lesson today. I hope it's been helpful. I know it's been about a half hour. I really can't make these things much shorter. I got a lot to talk about, but I do make these free videos for everybody. I want to educate everyone on how to trade options properly. Give me a thumbs up. Give me a like. Tell your friends. Don't forget to subscribe. Send me an email. I'll always answer your emails. And look down in the description. Read the description. I've got other things that could help you in your trading journey. I got links and websites and books and software things to look at down there as well. All right. Now, if you really want to understand what we're doing here, if you want to take a real deep dive into what we're doing, we have our video series right here. Go to our website, smartoptionseller.com, click on video series right here, and we'll bring up a deep dive, a 5-part video series that we have that also gives you 30 days to our put selling newsletter where we actually sell put options. So you'll get to be part of that as well. All right. That's all for me today. This is Lee Lowell. I'll see everyone in the next one.